Hi, it's James Shugg here with the end of day report for Wednesday, August the 31st. Look, it's all about Fed easing today. We had European markets open up very much in positive territory. The minutes to the Fed's August 9 meeting, of course, were released last night after European trading had closed, and the message in those minutes was that there was a much stronger body of opinion in favour of further ease, further stimulatory measures from the Fed on the FOMC than we'd previously thought to have been the case. Certainly Ben Bernanke, when he spoke last Friday, didn't really indicate that there was this growing or groundswell of opinion in favour of further easing that became apparent in those minutes. Now, not everyone shares this opinion, of course. We know there are dissenters, but as I said yesterday, one of those dissenters, Kokolakota, has kind of indicated he's perhaps not as inclined to dissent against further easing going forward. So we've had this building sense that something's brewing, and particularly given that the Fed now has extended its September meeting from one day to 2 days. They're not just going to discuss what measures they could put into place if judged necessary because of a weakening economy. It sounds like they're actually going to debate doing it, possibly as soon as September, or at least announcing something as soon as that September meeting. That's the vibe that's sort of driving markets today anyway. We did have some economic data around the various parts of the world. I'll just run through some of the numbers quickly. In the US, the Chicago PMI, a regional factory survey there, it only eased back slightly from 59 to 56.5. Nowhere near as weak as most of the other regional factory surveys have been. In fact, the Milwaukee factory survey actually rose slightly. Despite that, the overwhelming message for August has been of much weaker factory activity, and that's why we're expecting the factory ISM, the national survey, which is coming out tomorrow, to dip below 50 for the first time since the recession in 2009. Factory orders numbers, they posted a 2% odd gain, pretty much as expected, but most of the information we already had in that report. The only new information was a 1% rise in non-durable orders. What was interesting was Canadian GDP in the second quarter contracted slightly, down 0.1% in the quarter, 0.4% annualised. You could regard that possibly as a sign of weakness in the US economy. That was certainly one of the things that held back Canada. The strength in the Canadian dollar, and which hit the export side of things for Canada, was one of the other major factors there. The other data that just worth mentioning quickly, European unemployment back at 10%. It was at 9.9. It started edging higher. We may have seen the bottom for European unemployment, and German unemployment numbers today, although we did see a fall, it was only a small, single-digit fall. Nothing like the 30 to 60,000 per month declines that we had been seeing up until earlier this year. So wherever you look, there's some, softer activity data, with the exception of some not quite as weak as expected numbers in the US today. We did actually see stock market sentiment dented a little bit by Mr. Rabini, Dr. Rabini, Dr. Doom, as they call him, the guy that is credited with predicting the last recession. He's talking about a recession for US and Europe in 2012. This news report came out middle of the afternoon, saw a temporary dip in equities until investors said, well, hang on a sec, if he's talking about recession, that means there's going to be an even better chance of further stimulus, and so we quickly saw the equity rally resume again. As I say, it's all about the prospect for further easing from the Fed. That's what markets seem to want to see, and they're pretty much interpreting everything they get in terms of what it means for the prospect of further quantitative easing. So just quickly, on the commodity markets today, we had, before I go into that, most important, we had the private sector payrolls report from ADP, came in at 91. That's its second 91,000 increase in August. Its second weakest growth rate for the year so far. This number doesn't have a very good relationship in terms of the monthly payrolls numbers. For example, it undershot the the July private payrolls figure that's officially released by the Bureau of Labour Statistics by 40,000. Just think, if this month in August it actually has overshot by that amount, in other words, 91 for ADP, therefore 51,000 increase for private payrolls when the figures come out on Friday, take off another 30 odd thousand for government jobs, and you're left with a 21,000 increase in total payrolls, which happens to be in line with Westpac's 20,000 forecast. Look, you can interpret these numbers anyway. We're certainly not changing our forecast for a weak payrolls number on Friday. Okay, in terms of market centres, to give you some numbers really quickly, commodity prices are generally higher with the exception of oil, which is unchanged today. We're looking at $88.87 a barrel. Offsetting this sense that there's a better chance of QE from the Fed or further QE, we had inventory figures. They come out weekly, which showed a run-up of the oil stockpile. So that put a bit of offsetting downward pressure on the oil price. Copper prices up 1.6% today. Gold's up nearly 0.5% today, $1,837 an ounce, and the Aussie dollar is back above, just back above 107 against the US dollar, grinding higher in line with the positive sentiment on equity markets. And on that point, it's about 20 to 6 in London at the moment, and the Dow's up 0.8%. We're looking at 11,655. European markets, very decent gains today. The FTSE up 2.4%, French market up just over 3%, and the Germans up 2.5% as well. Today, your time in Australia, things to look out for, the retail sales report for July, where we're looking for a small fall to come through. Consumer confidence has fallen sharply in Australia. We think that's probably impacting on the retail numbers. If we're right, that'll be another sign that the economy, domestic economy in Australia is slowing, helping to build the case for a rate cut from the Reserve Bank around the end of the year. And we also get quarterly business investment numbers and also the latest update on investment intentions for the next year or two. The quarterly number in particular is useful. It helps us refine our GDP forecast. The second quarter GDP, of course, for Australia coming out next week. Okay, I'll be back tomorrow with more.